So first and foremost, I'd like to welcome everybody to the presentation today. My name is Sean Kozak. I'm one of the co-founders of ARC AI. It's one of the NeuroStreet companies under our umbrella. And I've got my team here today. We're going to be gracefully assisting questions and going through any Q&A if you guys need help. Just a couple groundkeeping rules before I get started is we are recording the event and we will distribute that recording after. And, if I don't get to your question right away, rest assured I will, or we'll just save it to the end of the webinar. Mainly just I want to stay on topic and go through some of the details. And my team's here to help me. If I'm going through the presentation and you have a question that they can answer, they'll be more than happy to do so. If you can't stick around to the end, don't worry. We'll send everything out post-webinar. Just remember that if there is anything that requires you to be for tomorrow, I know we're doing an AMA tomorrow for people that are using the Algo. So just make sure you check your emails today if you have to step out because there'll be important information that you're going to want to pay attention to before tomorrow. So with that being said, let's get into it. So today is a launch webinar. We have, as many of you know, or I see a lot of familiar names in here. Some of you have purchased algos from ARC before, and many of you know that we have a fairly aggressive development team with R&D. Our mandate with ARC is to produce top tier solutions for traders, whether that be indicators or algos. And the main goal with the algos is to provide automated solutions for traders that are looking for a better edge, right? And we're going to get into algo trading versus discretionary here in a moment. Now, today's focus is going to be on the IBOB. It's got a unique name because it stands for Inside Bar, Outside Bar Algo. And the thing about the IBOB is that it was designed, its design comes from the old mechanics of pit traders. And I'm going to get into why that's important. I'm going to get into how we came to learn about how to build these algos and what they're doing. But the uniqueness of the IBOB is that it's going to basically push some boundaries. It's going to probably, challenge some norms when it comes to some of the myths and things that you're probably aware of with regards to multi-time frame analysis. And I'm going to get into that here because I found it to be quite impressive when I learned about some of these concepts. And the uniqueness of it is that, you could catch some pretty explosive trades done correctly, and you would never be able to get in on your own with these trades. And that's the whole point of automated entries, and it's pretty key. Now, the reason it's from the pit, and we're going to get into this in just a moment, is because back in the day, pit traders only had access to price action data, mainly the open, high, low close of the prior time frame that was available to them. And I'm going to get into that and why it's so valuable and why it still holds precedence today. So this is a new product. This is definitely cutting edge tools. We're going to get into this and we're going to get started. So how many of you guys are familiar with inside bar analysis or outside bar analysis? Give me a yes if you've ever heard of inside bars or outside bars. It's a very simple concept, but very powerful. And we're going to get into this here right now. Okay. Now, in order for me to go into these details, because it is an event, we will be talking about performance. I can't guarantee results, nor do I want to. And I'm not your broker or your CTA, etc. Due to industry regulatory laws, we have to put this disclaimer in here. So if you could do me a favor and just type a Y in the chat box that you accept the risk disclaimer, etc. And that way we can get into this. Want to make sure we're all here and we're all professionals. Okay, great. If you have any questions on legal, send us an email and we can get in touch with the lawyers. All jokes aside, let's jump into it. So the reason we like to lead with this, I like to lead with this discussion, is because you'd be surprised when you sit down and you talk to traders. Traders are a fickle breed, right? I've been in this business a long time, right? Running rooms, we've got a lot of instructors, met a lot of great guys, gals, you name it. And it's interesting through the years of trading and building products and working with traders, you learn a lot about how a lot of different people come from a lot of different walks of life, different struggles, different experience levels, different passions, different intellect, different educational norms, right? But when you bring them into the trading realm, all that kind of basically just kind of goes to the side, right? Because it doesn't matter who you are. and where you come from, we all want the same thing. And that's what, like, there's a lot of things on this slide here. I could go into them, winning trades, and you don't want to get in, less emotional interference, and accurate results, and you want to have better execution and all that stuff. But when you sum it all up and you sum up all the technicals around that, what do you think it is? What is it that most matters? Anybody here? What really matters here? That. I'm not here to give you any bullshit fluff. Like, I could give you through the PowerPoints and all that stuff. That's fine. But making money, guys. Trading is a business of making money, right? And the trade-off with this is time. Trading. Everybody here wants to make as much freaking money as possible. Is that a true statement? Can you guys just do me a favor and tell me if that's a true statement? So money equals time plus S. What's S? I'm going to ask, what do you think S means? Security? I'm just saying, if you guys, strategy, spare time, spare time, skill. Okay. And this is the problem. That's the problem. The problem is, and I'm going to probably push some, I'm going to wrestle some feathers. Most people don't have skill. So I'm here to challenge the norm a little bit, because I don't care if you've been trading for 20 years or 20 minutes. Time does not equal skill. Education does not equal skill. So one of the things that I see a lot is that people spend a whole lot of time, but they don't make a lot of money. And so what algo trading does, right? What algo trading does, okay, time plus Q or A. You could call Q quant or algorithmic, whatever you want to do. By bringing in algorithmic information, you have data. And data bypasses skill. I can take, I don't want to use offensive wording in here, but let's just say less inclined individuals who are struggling with emotions, focus, whatever is causing you your problems, I don't know. But I guarantee one thing, that an automated strategy that has expectancy or has an edge will outperform a retail trader that doesn't have a skill or doesn't have an edge, period. I know traders that are very good traders, but they don't use the right strategies and they don't make any money. I know really bad traders that have good trading systems that other people are making money with. They just don't make any money because they're a shitty trader. So by bringing in Q, I'm replacing you. Are you okay with that? That's the question. Give me a yes or a no if you're okay stepping aside for a little bit to make some money. Now, there is going to be a level of there's going to be a level of human involvement, but if you can get rid of your ego in exchange for money and understand how to use quants or algos or data to support your goal, which is money, you can really, really do good here. Okay. So give me a yes that you're all willing to step aside a little bit and let me show you how to let our tools solve some of your headaches. Yes or no? Okay. I know we've got these nice fancy PowerPoints, but I kind of have an unorthodox way of teaching. I just been doing this so long. I just like to bring things, spice it up a little bit, right? You okay with that, guys? You can read the slides and take a screenshot, but I'm going to bring some golden nuggets today. Hopefully that's okay. So I've kind of just summarized this. You can let a computer replace you. I'm not saying that you're the only thing that needs to be replaced. You still need to set the algo up, and you still need to understand how to use the templates, and you still need to understand what the strategy is doing. That's my job, and that's my team's job to make sure you understand that. We'll show you that. If you let us show you how to use the settings, if you let us show you how to set it up properly, and you let us show you how to get the best out of the tool set, that's our job. You can let the algo do its job, because the algo is going to increase the execution speed. It's going to be more accurate. It's going to remove your emotion. It's going to give you data through backtesting and optimization. The data, I'm not here trying to sell the data. A lot of people will try to sell you an algo. Wow, look at the performance. Ooh, the equity curve is going straight up. Okay, yeah, that's good. Okay, there's nothing wrong with that. And you need that, right? You need the data. Why do you need backtesting and optimization? Why is it so valuable that when you use an algo, you can see the equity curve go like this? The biggest problem with everybody is they think that, oh, you're over optimizing. Yeah, you probably are, right? If you're curve fitting a strategy. Most people take this concept and they use it in the wrong context. You can't just rely on a back test. That's an idiot's way to lose all your money. Why? Because a back test is the past. I'm here going to try to sell you an algo today, and most people are going to try to sell you the performance. We have great performance. I don't need to sell you that. I need to sell you the truth. The truth is that if you only rely on a back test, you're only relying on one side of the equation. What does the back test do? What does the optimization do? For those of you that are been in an event, or maybe not been one of my events, but what does this do? Anybody? Neon says it's a guide. Okay, it's a guide. Anybody else have an answer to this? Are you guys awake? Expectation. Increased probability. Okay. It gives you comfort. Just end of story. We're human beings. We're freaking emotional creatures. Money is emotional. Trading is freaking emotional. So let me just explain this for a second. If you and me, okay, we're going to get up and we're going to trade every day. Okay. And let's say we're trading for 30 days. What is the likelihood of you logging every single trade, win, lose, or draw, marking up your chart, showing the entry, showing where the stop was, showing where the target was, you logging those trades, tracking the KPIs, being able to see on which days it was profitable, which days it wasn't, which time of day it was profitable, which time of day it wasn't, like which time frame was profitable, which, right? Here's the reality. Like less than 1% of you are going to do that manually. So what everybody's doing manually is they don't have the data. So if you don't have the data, what are you running your business on? Hopes and dreams. Neon nailed it. Hopes and dreams. You're wishing, which is a freaking casino. End of story. You're hoping. okay, this pattern looks good. Oh, that pattern looks, I've seen it happen before. So many traders, and I know great traders that come and they say, hey, Sean, I got an edge. You know, can you code it? Hey, Sean, I've got this concept. Let me show you what I got. And I look at it and I say, okay, well, how many of trades have you taken of this trade? How many days have you traded this? Do you have a performance log? Can you show me your trade data? And they're like, well, no, I've just been looking at the charts. Your mind will play tricks on you. Your heart will play tricks on you. Your emotions are going to step in and ruin your business when you don't have data. Now, there's a few people, they're the exception, that have been around long enough that actually log all their trades and do it right. But for the rest of us, me included, I get lazy sometimes. We can all admit that who the hell wants to sit for another hour every day and logging everything and marking up? Backtesting gives us data plus comfort equals an opportunity to do something in the future. We're going to use historical results to give us evidence that it worked in the past, which is a hell of a lot better than just starting trading today without having any information from the past. Now, you need to trade things forward. You need to rely on the data moving forward, which is called a walk forward environment. Some people will call this Monte Carlo simulation. I just call it real trading. Like, put a freaking name on it, whatever you want. You need data so that you can believe in something. Now, all the other stuff, absolutely. Quant trading is going to do it all for you. But that's not what really gets everybody interested. I've been around long enough to know I built hundreds of these. I just know what drives us individually and what drives us at a business level. Does this make sense to you? Like I could go into all the other problems you have. Maybe, you've got, I don't know, some of you have different problems. But am I on the right track a little bit with like what really kind of resonates with you guys? Like, I'm going to show you some performance results today. And what those are designed to do is they're going to basically give you evidence that this system has expectancy in the past. And you can give some fair warning to the future saying, wow, okay, this is pretty solid, right? Now that's only one side of the equation. Okay, that's only one side of the equation. Okay. Now I'm gonna basically do one more thing here. So what I've done is I've basically gone over the benefits, okay, of an algo. Okay. So we've talked about that, but that's not enough. You also need to have a very good signal. You need a good entry signal. Like an algo is going to do a whole lot of things. An algo is a computer, but you still need a good strategy. Like, there's a lot of shit algos out there. There's a lot of freaking auto traders out there that are black box, or that, like everybody's got an idea, but that doesn't mean it's good. You need a good signal, which means you need relevance. So one of the things we do with ARC is we have an R&D team. Research and development. What comes first in R&D? Give me like what's the first? Is the R or the D? The R. What do you think R stands for? I'm not going to use I'm not going to say it because I don't want to use the R word, right? What do you think R stands for? Research or retard? Right? You get, like, are we research or are we approaching the market retarded? Right? Like we're researching, right? We spend countless freaking times going to the drawing board with very advanced traders and a lot of experience and a lot of programmers and just people that have their head on straight. And we research systems, we research concepts, we study very good traders, right? We look at things that didn't work, things that did work. We mix and match, we integrate, right? Our research process starts every quarter and we bring in research. And what we do is we prove relevance. Once we prove relevance, then what we do is we go back to development, because if it's relevant, relevance is very important. Relevance means the system signal works every day. It has an edge. It has repetitiveness. You cannot run a business on an auto trader that's not trading on a daily basis. You can't run a business if your signal's not firing today, and if it only works in one type of market, or it doesn't work in other types of markets, or it only works on one market, right? Like those things are non-relevant, because what those are siloed environments. Those are dangerous types of strategies. And so once we prove relevance, then I pull out my checkbook and I spend a shitload of money developing algos that we want to get behind and build. Once we code them, that's when we get to see if they're a good signal. So isn't there a level of risk involved here? Where do you think the risk is at our level in terms of the development? The risk is we could develop something and we still don't have the data yet. Once we code it, that's when we get the data. That's when our team goes in and spends literally a month, right? Literally a month, literally in the trenches, 7 days a week, building, optimizing, testing, back testing, running it on different timeframes, running it on different markets, so that we can build profitable and relevant and expectant templates to give our users. There is no vendor in the world, and I mean no vendor in the world, that does what we do in the quant space. That's a given. We're the leaders in the business. So big that even companies bigger than us are now starting to sell our algos, because we're the best in the business at this. So why is that important? Because ARC has a secret sauce. We have an R&D team, and we have a development team that has rebuilt NinjaTrader's infrastructure. So what do I mean by rebuilding NinjaTrader's infrastructure? NinjaTrader has a plug-and-play basic backtesting engine. We took it and flipped it on its head and created a custom quant testing framework that allows you to build, test, and optimize your systems. You can basically rely on the best developers in the business, because we got them. I can promise you that. They're on our team. You can build your systems, you can trade them, you can test them, you can optimize them. But the difference here is that you can basically go, let's just skip right down here, all of this. We've built an engine that allows you to test trade management, stops, targets, trailing stops, filters, blockers, money management, risk management. Like, we literally built our own quant infrastructure inside of NinjaTrader, so that you're not just getting a signal, you're getting a signal plus an engine. When we call the engine, what do we mean by the engine? What that means is that you literally have an entire framework for testing different algorithmic signals and filters, trend filters, momentum filters, price action filters. Why is this important? Because we could build something and give it to you and it's very successful, but you could probably take it and do 10 times more with it as well. And this is just something that this doesn't exist in any other environment. This is a benefit just by being an ARC client. So I'm leading with this because it's in all of our algos. This is in every one of our auto traders. And I want to make sure that you know that you're getting that. And that's why, using ARC products, there's an advantage to it. So for those of you that are new in here, you're in the right place for an algo environment. For those of you that have used at least one of our algos, or at least know our algos, you can understand why we spend so much time talking about the engine, because it's the backbone to the success of our signals. Now, price action. Today's algo is a price action algo. We're going to get into what it's doing, okay? When you use price action, a lot of times you get faked out. Why do people get faked out? Have you ever heard about fake out breakout, FOBO? Fake out breakouts happen a lot because most people don't really understand breakouts. They don't understand price action. They don't understand what the price is actually telling them. They look at a chart and they see all these bars and they try to make sense of what those patterns are telling them, but it's not really good information because you're relying on what's going through your receptiveness rather than what's really going on in the data. And what ends up happening is most people, they wait for confirmation, or they try to time their signals, or they need XYZ to line up. And then what ends up happening is that they miss the trade, or they basically don't know where to get in because they're not sure of that. These are just a lot of problems that happen with price action traders, because a lot of traders rely on indicators to help make those decisions. But when traders use price action, it can sometimes confuse people. And that's why a lot of traders love indicators, because indicators somehow fill that void emotionally inside their psychological makeup that says, if X crosses Y, buy here, right? So that's why so many people gravitate to indicators. But when you remove indicators, what happens? You're dealing with real-time data, and that's not lagging, which is an advantage. You're getting into things that are happening without lagging or misreading information. Signal systems on indicators, you end up reading price. Exactly. And when you can read price or rely on a computer to help you read price, better yet. So what we're going to do today is we're going to talk about inside and outside bars. And I want to give you a little backstory around inside and outside bars, because it's not just as simple as understanding, oh, it's an inside or outside bar. There's some pretty significant things that many of you may or may not know about inside and outside bars that I'm going to teach you. I learned it from traders that used to trade on the pits, and they were in the UK. It's an interesting backstory, but I'll tell you about this. And basically, there is no subjectivity about this, because you can't deny what an inside or an outside bar is. Like, it's either A plus B equals C, right? And what I'm going to do is I'm going to go into this, okay? You're going to be able to automate pattern identification. It's very important that you understand that this is a price pattern algo, okay? And what's really unique is that we've created auto-adapting money management. Why is that important? Is because when you trade price action, every candle is different in size, which means your risk management has to auto-adapt to the size of your stops and targets based off of the bars. If you don't have an algo that is auto-adapting for money management, you're in a very dangerous place. I promise you, you do not want to trade automated systems unless money management can be a part of the efficiency of that algo. Okay, we have that built in. And the reason this is unique is because, the reason this is unique is because 80% of our users trade for prop firms in the futures business, okay? And the rest are in stocks and Forex. And if you're going to be trading for a prop firm, you need to make sure you're sticking in tune with your money management. More importantly, we're running all of this on day trading environments. Day trading environments is important, right? Where this isn't, you could trade it on swing trading and investing stuff, but the primary focus will be day trade, okay? What I love about the IBOB is it's not complicated. Not complicated. I like simplicity. In fact, some of the most profitable and best algos we build, you would be surprised, are the most simplest. Are you guys okay with that? Do you need a complicated system to make money? Are you guys okay with me giving you access to something that is very simple, very easy to understand, right? Or do you want me to throw in a whole bunch of freaking other things that just mark up your charts and like just confuse the hell out of you? Just give me a KISS. Just type in KISS. Keep it simple, right? KISS in the chat box. I know we're all on the same page, right? There we go. Okay. So what you're seeing here is an example of a long and a short. We're going to get into the mechanics. That's a long signal. That's a short signal. And you're probably saying, well, what the hell is the rules for that? Okay. Well, before I tell you the rules, I want to talk to you about why the pit was brought up. I'm not a big believer of adding fluff. I'm not going to sit there and say, oh, I learned this from market makers, and oh, this is the secret sauce that the institutions are trading. That's a bunch of bullshit. If anybody's telling you that, guys, they're just trying to market to you. Run for the hills. They're more stupid than you. And you're not stupid, right? Don't listen to somebody that's going to use that as their sales pitch, right? That's outdated, like 1995 outdated. Okay. But what do you think pit traders had access to? This is unique. I want to talk to you about this. What do you think pit traders had access to? They had access to data. Yes, they did. But predominantly what data? When they're standing in a pit, let's just draw this arena, and you got all these freaking people here. These are all heads. They're all heads, and they're all screaming, and you got this screen up here, and they're all reading it. What do you think they had? And these are all the price levels of the markets, right? They didn't have access to order flow. They had access to price data, but they didn't have access to order flow. Okay. They could see the bid and ask, but only in real time, yes. But what do you think they had access to? Pit traders have access to the daily candles. They have access to, say, like the 4-hour candles, the 60-minute candles, the 5-minute candles, the 1-minute candles data. It doesn't matter what time frame was being traded, they had access to data. Within each of these time frames, what is a constant? Every constant is a bar. Okay. What is a constant in every single bar? I'm going to teach you some holy shit stuff here. There you go. Nail it. Steven, you get a bonus. Whoever Steven, Miss Ashley or Jim's, he just nailed it. Open, high, low, close. Give this guy a cool gift or something. This is the open, high, low, close. Let's just pretend that's an UPGAR. There's the open, there's the high and the low and the close. Everybody had the ability to see the high and the low of the prior environment's range. They also was able to track the open and the close. That is very, very important data to someone that is literally relying on they're only relying on that. Okay. Now, I'm going to take this one level deeper. So if all of the people that move from the pits to the electronic trading environment who run all the money in the world, right? Retail traders don't move the market. The guys that traded in the pits, they're mostly trading for family offices. They're running prop firms, or they're hedge fund traders, or they're just trading a big book of business. They all learned this first. This is what their foundation was built on. Yeah, exactly. The central bank moves money too. Yeah. They print a whole shitload of it. So the whole point of it is that this information has never left us, but people don't understand what it's doing. Now, does everybody understand the relevance of where I'm going? I'm just trying to teach some theory here, and I'm going to get into the signals, because I could just show you a bunch of signals, but it's like trying to get you to buy a Porsche, but you don't actually believe in a Porsche engine, right? Like I want to give you a few things here that I think will be valuable. Are you okay with me teaching a little bit of this stuff? I just want to share some things with you guys, and I'm going to take this one level further. Okay. So how many of you guys have ever heard higher time frame equals more powerful than the smaller time frame? Right? You guys have all heard that? So I'm going to draw a little picture here. Okay. And let's say right here, this is a 4-hour supply zone. Okay. It's a pretty big time frame for a day trader. Yeah. Okay. And let's say we're trading down here. Okay. And right inside of here, maybe you're on the 3-minute chart. Let's just use this as like a magnifying glass here. We're just going to just like little, there we go. Okay. So let me ask you this. What's more important, the 4-hour or the 3-minute? This is where I'm going to see if I can get everybody confused here. Hassan says the 4-hour. Neon says depends on what you're doing. Now we're starting at 3 minutes. Steven's okay. Steven, are you just saying that to see if you push the norm? I'm going to explain this. I'm not here to say that the 4-hour level is not powerful, but everybody that I've listened to over the years has it asked backwards. Okay. Higher time frames will dictate the market at certain parts. Like they're gonna basically impact the market, right? Like you're gonna have more power at a higher time frame level. It may do things differently than, say, a smaller time frame. But let me get this straight. What happens on the 4-hour isn't what's changing what's happening on the 3-minute. What happens on the 3-minute has to occur first in order for us to even get to the 4-hour. And this is where everybody has it backwards. The smaller time frames dictate the higher time frame charts. The 4 hour is important, but the smaller time frame comes first. So what ends up happening here with an inside bar, and now we're getting into signal logic, we're going to talk about that, and an outside bar. Okay. An inside bar is when I have a candle. Let's just call it a 3-minute candle. Let's just say it's an inside bar and a 3-minute chart. Okay. Okay. And then the next candle here opens here, trades down here, comes back here, and closes there. Trades up there and closes here. Okay. There's the open and there's the close. This is what we would consider an inside bar. Okay. Now, the reason this story that I just told you about a 4 hour and a 3-minute, it plays relevance because these are both on a 3-minute. Okay. As a day trader now, I'm going to take it into the prop realm. And as you scalpers are probably wondering, Jesus Christ, I'll get to the point. These are both 3-minute candles. Okay. But I need you to understand something, that there's a range that's created from this 3-minute candle. And what is this inside bar telling us? This is what I want to see if you guys understand where I'm going with it. What do you think the inside bar is telling us? Anybody have an answer to that? It's telling us what's going. Nikki, you nailed it somewhat. Yeah. Okay. So Nikki said consolidation. I'm going to run with it. Consolidation, indecision. Okay, but hold on a second. If it's staying inside the prior bar's range, all that is what's going on a smaller time frame inside of this environment. What that means is that it's probably doing this. But it's not probably, it is doing this. Creating a range on a 1-minute. It's an internal fractal. Inside bars are what we call internal fractals. Now, if we have an outside bar, same thing like this. And then this opens here, sweeps the low, then trades all the way up here, sweeps the high, and then closes. That's an outside bar. Okay. What this story is telling you is that the market is getting liquidity from the low and the high of the prior range. Very rarely does this make sense on small time frames. So what I'm going to do is I'm going to write down a little golden nugget. For those of you that are paying attention here right now, inside bars are good for smaller time frame day trading. Outside bars are medium time frame to larger time frame day trading or swing trading. You will find more efficiency and you will find more better trades. Inside bars are what we found from the data. This isn't just Sean giving you some random bullshit. This is months of data that has shown us that inside bars work very, very good for the intermarket day trader, the scalper that is looking for inside bar breakouts. The outside bars normally happen when liquidity sweeps happen on like a 15-minute chart, because it normally sets up for the big move of the day. So what we've built is we've built some templates that are good for the scalpers and the day traders. Okay. And then this is the big move, the daily big move. Okay. What we found is that you can almost get daily big move. You know that normally every session on a moving market, there's normally 1 or 2 big moves a day. Yeah, you guys know that? Like, and you're probably wondering, like, how do I catch the big move on these days? How many of you guys would like to be able to find that trade setup that, you know, you can peg? You're not going to get a bunch of trades on the big move. It only happens once or twice a day, but there's the big move, right? So what we found is that we've built the inside bars to accommodate the intraday traders. And then the outside bar signals, what we found has been very good to catch the big move of the day. And then what we did was we found templates on more than 4 markets. We built templates on the S&P, the NASDAQ, crude oil, and the Russell, because what we wanted to show was that it doesn't matter what freaking market you traded on. It just matters that you understand price is price. Okay. So did you guys learn something here from this? I just want to make sure that this is something that you can take from, like, some pretty important stuff here. This is months and months of R&D coming into this discussion. I want to make sure you understand that this is evidence-backed information that isn't just Sean trying to throw theory at you. I want to make sure that you understand this is important. Okay. Okay. So I'm going to remove it now. So let's get into this. Inside bar, outside bars. Our software is going to auto trade inside bar breakouts and outside bar liquidity sweeps so that you don't have to figure it out. It's hard to find them. If you were looking at a chart, once in a while, you're going to see, oh, there's an inside bar. You're probably going to miss it. You're probably not going to get the break signal when it matters. And it just depends on the time frame or the market that you're trading. Okay, so this is a chart. This is a chart of a 1-minute chart on crude. Now, we have some templates that have, stops and target. The stops and targets are going to be dynamic to the size of the inside bar or the outside bar break. So when you say, oh, it's small stops and targets, well, hold on a second. If you have an inside bar that's running something like this, okay, but then you have an inside bar that's, running like this, they're both an inside bar. The breakout is going to be different because the stops and targets are going to be different. So our auto traders auto adapt to the signal logic because price is dynamic, right? We're not trading on just a 10-tick range bar where there's no evidence of information. You can't use these types of things on range bars and Renkos because you don't have data to be able to back the signals. And so this is important, okay? So if you don't know what an inside bar or an outside bar, we like to say, are you an innie or an outie, right? All jokes aside, right? An inside bar is going to be when we have an intermarket range. This would be a great example since it's on a 5-minute. That's more than likely this on a 2-minute chart. And the way that we can enter the trades, okay, and we're going to get into this in a moment. An outside bar, you can see an outside bar is we've got a range, and then we get a trend. This would be considered a trend on a smaller time frame. If this is a 5-minute, this is a smaller bar, but this would be a big uptrend, right, on a smaller time frame. So now this is important. If you get an uptrend on a small time frame, eventually the trend ends. So normally after outside bars, you get these consolidation periods on small time frames. You get this on a big time frame and it's taken the market with it because it takes a lot to move the market on a bigger time frame like that. So normally that's big money stepping in, moving the market on an outside bar. And that's why I'm just trying to tell you that this is what we found, and we'll be able to show you some examples, okay? So let me just talk a little about it, the long and the short about it. We're going to talk about inside bars, okay? So let's talk inside bar for a second. This is the bar 1, okay, bar 1. We call this the mother bar, okay, the mother bar. The mother bar is the primary candle of the pattern. You'll notice that these are all inside bars. Inside to the mother bar. The mother bar is here, okay? The mother bar is here. We have the ability to enter long or short on breaks of the mother bar or on breaks of the internal bars. So it just really depends on how you want to execute the entries. But either way, we can set the systems up to execute on the mother bar or the inside bar ranges. Here you can see another great example. You get the mother bar, which is bar number 1. You get an inside bar, which is an internal market fractal range, and then you get the breakout. Now, the thing about me is like I said, keep it simple. If I'm looking at several different markets, or I've got a trade room moderator speaking on one side of my brain, and I've got a YouTube video playing on another, or I've got a trade going on in a different environment, right? Here's the thing. you're going to miss these. And that's the problem without auto traders. Like, you're not going to be able to act quickly, okay, in the event that you need to, unless you're laser glued to the screen and you're just absolutely Johnny on it. You're going to see everything. Your mind is going to play tricks on you. And that's the advantage of being able to automate the price action, is because most people recognize it after. Okay. Yeah. So great example, mother bar. Let's just use this as an example. Bar number one. Okay. Bar number one is always the mother bar. Okay. Every bar that comes after it, right here, inside the high and the low of that would be considered inside bars. You could have one candle or you could have two, right? Just depends. Sometimes you'll get a pattern like this. Sometimes you'll get a pattern like that, just with one candle, and then it breaks, right? Or it breaks. Whatever the case may be, the mother bar is always the first bar that sets the range to the inside bar. And so when you have a signal, you can enter trades, okay, at the break long of the mother bar or the break short of the mother bar, or you can set the trades on the break of the inside bar, right? These are the inside bars. And this is, our software does both. The user documentation explains this very, very accurately, and it's, God bless Jeff and his patience. He's just the best in the business at it. But he's, we enter on the breaks. Yeah, we don't enter on bar close. We enter on the breaks. So we enter long or short on the break of the bars, and you can set it on the internal bars or the mother bars, depending on how you want to test it. Let the data show you that, right? Don't guess, like, we let the data. So the outside bar is just the same, but it's an outside bar. Bar number one is the mother bar, and then you have the outside bar. Our signal is different on the outside bar because it relies on the break of the outside bar, not the mother bar. So this will be a great example of, you get an outside bar, it dwarfs the inside bar. You can see that there's the inside bar, or excuse me, the bar number one, and then you get the mother bar or the outside bar, and then it breaks down. And so this is why, I personally have seen bigger success trading the outside bar signals on much higher time frames, like 15-minute, 30-minute, these types of things. The inside bars are just great for day trading. Okay. Does everybody kind of understand that? The long and the short of it, right? Like, it's a pattern recognition environment, straightforward, okay? And we've seen very good success with it, right? Like, so to kind of put things into perspective, like, when you're able to see very good metrics, stability metrics over a decent size sample size, like months of data, that's important, right? Like what you want is you want consistency over days and days and weeks, because price is price. Inside bars happen every single day. Outside bars happen every single day. So this is the whole benefit of using this type of an algo, is that it's not based on some indicator that has to happen once in a while. You can build a business around that, right? This is a great example of, just different settings. This is a scalp template. This was ultimately very, very tight scalps, different scenarios, right? And yeah, both inside and outside. We have the ability. We could have just built two different systems, Gene, but we decided to call it the IBOB, which is IBOB, inside bar, outside bar, and merge them together. So you actually get two algos in one. That's the way we structured this, is you actually get two algos in one with this system. So you can take advantage of the day trading scalps, and then you can also take advantage of the bigger day moves as well. So you can run them simultaneously. Yeah. So we'll get into that here in the templates. So this is a great, another example. I think this was on crude. I'm not sure, but this was on crude, and this had some pretty good, like this was really good, like 80% hit rates with almost a 1-to-1 R multiple. Like, like I said, I'm not here to, yes, I understand when you see a back test and you see really good metrics, of course that gives you the evidence that it's working. We don't bring to market algos that don't work. So that's just the reality, right? Yes, it takes some testing, and yes, that's why we build all of the templates for our users to start with. But I mean, when you can get, 0.9 R multiple, like I'll give you an example, when you can get 0.9 R multiples, right here with an 80% hit rate, like, come on, like that's almost 4%, 4 profit factor, 3.6 profit factors. That's very, very, very good. Right. So we'll get into that in a moment, but these are just great examples of just different examples. Like, here's a great example, like 0.75 R multiples with a 75% hit rate. Like, that's amazing. Like, that's absolutely amazing. Right. And this is recent, right? This was literally recent, since like the 5th of February to like a couple days ago. Right. And so the stops and all that, yes, they all adapt automatically, Riley. We'll get into questions after. Okay. So a couple things that we'll talk about the money management. This is really, really important. Is that because every candle is different size in price? Like a 1-minute candle is a 1-minute candle, but you can have a low range or a high range, right? Our algos have a built-in money management tool that is only available in the new engines that allow us to basically, we can set the quantity of risk. You could do a fixed cost, or you could do a dollar size risk, percentage size risk. You can change that every chart, every trade takes 2% risk or 1% risk. Some of you want to, I don't agree with percentage risk models for prop trading because it doesn't make sense. You could be trading you could be trading $100,000 eval for Top Step. And if you basically risk 2%, well, you've already done max drawdown on one trade lost. You can't do that. So prop traders are going to normally run dollar value risk, which is like $200 a trade, $100 a trade. You're going to risk $300 a trade. So we've built all that in to accommodate prop traders in the auto adapting money management functions. So this is very, very custom. Like, we pioneered this in the space with regards to the algos. Yeah, it's an advantage. It's a take the win, guys. Be grateful we spent the money on the R&D on this stuff. It's very valuable. Yeah, and it will help you with your prop trading. Okay, so a couple things that we always get asked: our algos are not black box. So you can stop them in the middle of a trade. You can have money management filters that will tell you that you've reached your money management targets or loss limits, and a pop-up will tell you to turn it off. You can't trade for most prop firms running a black box. They don't allow it. If they catch you, they won't pay you out. And sometimes they will. Like, if you're making a bunch of money and they say, well, that we want to see how you're trading, and you show them you're using an algo, and you're not able to control that algo, they're not going to pay you out, and you're going to get kicked out of the prop firm. We've seen it happen. So for me, we've built all of the algos to not be a black box. You can step in and manage the algos, turn them on, turn them off. You have the custom drop down menus. It's very flexible. Okay. So just so, like, some traders like to run automated entries and then step in and manage the trades. Some traders will run them as an automated system, and then they'll just turn them off whenever they hit target levels in their day and that type of stuff. You have full customization, which is very unique to what we do. Okay, so we're going to do a demo here. I've always believed in filming videos because I think filming videos shows a better example than like the markets. I can't control markets right now. Like, I can't stop the market and play it and be able to show you better examples. So we like to film videos. I think it's easier to understand them. And it just does a better job of explaining things. So Jim filmed the video here, and we've got it on 3 different markets. We've got it on the S&P, we got it on the NASDAQ, and we've got it on crude oil. These are all inside bar. Jim, I think these are all inside bars. Yeah, I think that's all you did on these was inside bar.
Yeah, these are inside bars. Yep.
Great. So I'm going to turn on this, guys. I'm going to mute my mic and let it play out. Jim's going to do some talking here. Okay, and I'm going to hit the play button, and you guys can watch this. We just recorded some of the auto trading entries, and you'll see, like, if you're looking at the charts and you're trying to catch the patterns, it happens fast because the markets are fast, right? And a 3-minute chart's pretty fast, right, for day trading. So we're gonna get into that.
Hey traders, Jim Simmons here with Neural Street Trading Academy, here to do a quick demo on the all-new inside bar, outside bar algo. What does it trade? Well, inside bars and outside bars, as you might have guessed. It's a price action algo. The way that we're going to take a look at it here today is we're going to show the breakout signals out of an inside bar. So I've got this set up on 3 markets: MES, MNQ, MCL, all on 3-minute charts. And let's go ahead and dive in and see what the algo can do. Here we go.
So it's just going to take trades, guys. It's going to run the algo. It's going to take shorts and longs, and it's going to run it. So you're going to see it's pretty hard to catch a trade if it's moving fast and you can see the market going. Now we've got it sped up a little bit just for the purpose of the demo video, but you'll be able to see it take trades. There it goes.
Okay, so that is a quick example of how this system trades. Let's go ahead and take a look at the trades. I'm going to go ahead and pull up the whole chart so we can break down the trade and take a closer look at what this did. So coming into this trade, we can see that we have a filter set on these EMAs on the momentum. So as long as the EMAs are down, the fast is below the slow, then that would be shorts engaged. So that's the only filter I've got going here. Otherwise, we're looking for inside bars. So we can see we've got a bullish bar here, and then we can see this bar is inside of this bar. And so when we get the breakdown, the market is entering with a buffer. Of course, you can set how many ticks below the inside bar you want it to go before you're willing to enter the trade. This one took a little bit of heat, almost got stopped out actually, but then went and hit targets. I've got the target set to 0.8 multiple as a risk reward multiple. The stop is set to go above the inside bar, which is going to be, I have it set to a little bit of a buffer there. I think it's 25% as a buffer above that bar. So really that's what it's doing here. So great trade there. Let's go ahead and take a look at the others. We had a couple in here. Okay, so looking at this trade, we had the market was coming up, and then we painted an inside bar inside of this bar. So if we're looking at the range of this bar, the entire bar was inside the range of the previous bar, and then the market came down and triggered the order. Stop again, goes above the inside bar, and we have a risk multiple of 0.8 on that signal. Coming down in here, let's take a look at what we have going on. We've got this bar, and you can see the bar is completely inside of the previous bar. Admittedly, this is pretty difficult to see on the fly in live markets, especially if you're trading with faster charts like a 1 minute or a volume chart that's really fast. And so really great to have the algo entering the trades for us and doing all the hard work in terms of finding the signals. So that's a great little trade there. Let's take a look at the other market and break down the trades here. So we'll go ahead and zoom in. We can see markets coming up. We had an inside bar. So now you could potentially trade long or short coming out of that inside bar, depending on your preference. You can use things like momentum. You can use moving average filters to set your directional bias. You can use structure, market structure. All of these filters are built into the algo, so you can use whatever you please. In this case, shorts were allowed, and the market made lower lows and broke through the inside bar, the low of the inside bar, and entered the trade. Stop again, goes above the high, and then there's the trade there, 0.8 target. Same thing here. We can see this is our first bar, and then this is the inside bar there. There's the break, and there's the trade. So those are the trades. There was one more. There's our first bar, and then there's our inside bar, and there's the break. Okay, so using this simple pattern, it does trade outside bars as well. So if you want to set it to trade an outside bar, you can certainly do that. I've just used inside bars as an example here. But that's a quick example of how the algo works, and of course you can add filters to make it do whatever you want it to do on your markets and based on the way that you trade, whether that's reversals or trends or however you want to trade with it. Trade it as you please. So that's it for now. We'll see you on the charts. We'll see you in the AMA. And for now, cheers.
Grab the mute button. So a couple questions that came in. I just want to talk about that for a second. Is that so Edward says, so the signal doesn't print until the direction of the breakout. Exactly. So we're letting price dictate the entry, because if you're not using filters, I'll give you an example, and this is valuable information, right? Like our algos, right? You have trend filters, you have momentum filters, you have price filters, right? These are filters that you can implement, okay? And those are part of the engine. But the signal logic is the inside bar. So like, let's say we're getting an uptrend here, okay? If we got an inside bar pattern right here, okay, and this is an inside bar, and we had we peg a, like, think of these patterns as we have a buy stop or a sell stop automatically engaged in the quant, in the algo. So what ends up happening is, like, if you're not using any trend filters and like literally you're just relying on the price action of the market, you could literally go long or go short with this algo when you get the pattern. Let's say you said, I'm only going to take longs in an uptrend and I'm using a momentum filter in this, then we would be blocking the shorts. And the only time we would get this signal is if we actually got the long, right? So we have filters that are on some of the templates, but you can literally use this to your advantage in both filtered environments or non-filtered environments. And it really just depends on the market and the time frame you're trading. We have definitely put some filters on our templates because we wanted to make them easier and more understandable. But, really, it really is open to you. And I think, Jim, tomorrow when you guys do the AMA, I think some of your templates were, I think, different than Jeff's, if I'm not mistaken. I think you had put your own templates together, right?
Yeah. Yeah, they're
So
on 3 minute. Yep.
yeah, so we have some pre-built templates that we've built for everybody here using the software. But Jim's gonna give you access to his templates tomorrow in the AMA, and Jeff's gonna be there because he's architected this with me on the back end. So I can promise you this: you're gonna get an entire toolbox of greatness from what we've built, because this system is, it really is badass. Like, it really is easy and it's repetitive, right? It just repeats every single day when you have the signals coming on the chart. So let me show you this, guys. We haven't really touched base. Like, these are all the different templates. So I've got several templates. This is the only outside bar that I've loaded, and you'll notice it's on a 15-minute chart. It's great. Like, you can make some big money on the 15-minute, and it's one of those, you catch the big moves of the day. Like, the 15-minute outside bar is like what Jeff's been able to find on these, is that you're catching the big move of the day. These are all the day trading templates that we've built. Day trading, day trading, day trading. This is the intraday. This is the outside bar swing trade. We'll call this the outside bar swing trade. And so let me kind of show you what the outside bar kind of looks like, because this is let me show this right here. I'll give you an example here. This is the last day, okay? And you catch the bigger moves, right? Like if you get an outside bar on a 15-minute chart, what that means is that the prior 15 minutes was here and it swept the liquidity and it took out the highs. So that's a pretty big move. As a day trader, that's a 15-minute chart. So you're going to catch some pretty big movement, and, if you come here, you see this is the candle, this swept the low, swept the high in an uptrend, you catch some big movement, right? Like, that may not seem like a lot. That's a 15-minute chart, right? As a day trader, those are two big moves in the day. Right. This is very, very, very valuable details that we've been able to find. These are just some examples of this, when you get into this, but this is the outside bar stuff. Right now, when you get into the inside bar, like we have templates for the NASDAQ. A lot of people have been asking us, hey, do you have anything on the Russell? Do you have anything on crude? Like, I know that these are kind of like off the chart markets that everybody asks about, but the majority of the volume is traded on the S&P and the NASDAQ. So we really went to town building out some templates for the Russell and for crude for all of you, alternative market maxis out there. But just remember that the NASDAQ and the S&P are the bigger players of the business. But nonetheless, guys, like, this is a NASDAQ chart. Like, when you look at this, like, I want you to take a look at the stats on this for a second. Like, I'm not trying to just pump the stats, but the stats do tell a story. What is the story from the stats? Remember, we talked about this at the beginning of the event. What does the details tell us? What does this back test and stuff tell us? It gives us data, and that data gives us comfort, because if I'm going to trade something, you better be able to prove to me that it had past performance that was good. because I'm not going to trust anything going forward if it didn't. Why would I? I'm not going to just believe you, right? I need to see it. And so one of the things that I look at is 0.8 risk reward ratio. That's close to a 1-to-1, but an 80% hit rate. That is massive. So if you're trading with a 1-to-1 risk reward ratio, you need 50% more. Okay. If you're trading with a 0.8, you need about 60% more. This is 80%. So the key here is that, like, this is why you have such a huge profit factor, is because it's very, very, very stable with a very, very low drawdown. Like 10,000 profit for 1,000 drawdown. Like that's great, right? Like that's really, really great, right? And your average trade expectancy on this is very good. Now this is all relative to size, and you could probably size up or size down, right? It just depends on the settings, right, that you want to leverage. But this is the concept of that. And I mean, I could sit here and show you all the sexy graphs, like on every market it's going up to the right. But that's the key, is that on every market that we tested it on, it was going on up to the right. Now, Jim's got his own templates. I think Jim's going to reserve those for tomorrow. He's going to share with you his templates, because I like the way Jim approaches it too. Jeff and I have our heads deep in R&D and the quant side, and Jim comes at it more from a trade room educator perspective. So I think, he has a lot of stuff on the 3 minutes as well. And so I'm excited to see what he's got for you guys, but all of these are included. So you're going to get all of these templates that come with the algo, as well as what gets done inside of the AMA tomorrow. So you're definitely in good hands. Okay. So let's do this. The winner is, who wants to win a free license? I think, Jim, you've got somebody here. We run a contest, and we have a winner. Winner chicken dinner. I don't know if he's here. He might be here.
I believe so. We have a winner. Okay. And let's just say that this trader can brag. And I think he probably knows who it is by now, because his name is Ken Bragg. There he is. He's like,
yeah, he can brag. He's got bragging rights.
Yeah, I love the name.
He can brag all day home. Yeah, you won
any
Ken.
competition, because his name is Ken Bragg. I mean, it's just phenomenal. I love the name. So congratulations, you're the winner. You've got a freebie. It's on us. And
enjoy the algo. Tell all your friends we love you. Thanks for being here. Just never know, if you show up, you grow up, right? You're here, right? So we've got your back. So did you guys learn something from today about price action? I mean, yes, we're selling a product. Yes, we've got a great system. But did you guys learn something about inside and outside bars? Did you guys understand the intra-bar market analysis that I referred to? These types of things, right? And I want to make sure that you're not just coming to these events, to buy something. Like, I like to make sure you learn things as you go, because that's what we're here for. We're here to help you. Jay Wu says, I'd be helpful to have all over. Yeah, so it would be helpful to have overall size. Yeah, it just depends on, like, most traders are risking about $500 a trade, $300 a trade, Jay, but we can't get into risk management. Like, you could be trading a $500,000 eval or a $50,000 eval, or maybe you're trading your own bank accounts. We don't really get hung up on how much risk per trade, because all of our algos are built for day traders. So they're always going to accommodate someone that's trading $100 or $500 or $1,000. It doesn't really matter. Yeah. Right. So what I'm going to do is I'm going to go over some pricing, guys. And we're going to basically go over the details. We've put together a package because we've updated a lot of things in the back end for the algos. So I want to